I'm Emily Chang, and this is the best of Bloomberg Technology, where we bring you all our top interviews from the week in tech. Coming up, Facebook projecting a slowdown in ad sales growth. Have expectations for the social network just been too high? Plus, Alibaba shrugs off China's slowing economy with another report of double-digit growth. How long can the world's biggest e-commerce company continue to defy estimates? And Steve Ballmer weighs in on the U.S. election, why the former Microsoft chief is advising CEOs to keep their political opinions to themselves. First to our lead. Facebook reported a quarter that blew past expectations with third quarter revenue just over $7 billion, up more than 50% from the same quarter last year, and a profit of $2.4 billion, up more than 160% year over year. It is the sixth straight quarterly revenue beat for Facebook, which has increased sales by more than 50% in the last 4 quarters. Yet executives suggested they won't be able to repeat the performance, and investors are taking note. James Chakmak of Monness, Crespi & Hart joined us, as well as our Bloomberg TV editor-at-large, Corey Johnson. Take a listen.
The expectations for a beat on a lot of metrics were quite high because Facebook has done so well. By any reasonable measure, this is a fantastic quarter for this company, an incredible 50% year-over-year growth at a business that's at scale. But I think that in particular, there was not an acceleration of mobile revenues as a percentage of sales, maybe. Right. It was hard to find reasons.
It remained relatively flat, 84%. However, that was 0 4 years ago.
But it
was
awesome. I mean, it's awesome. I mean, there are any number of statistics you look at and see that this is a fantastic report.
James, would you agree with that?
I would agree that it's a fantastic report, but I got to tell you, a quarter ago, right after the 2Q print, we downgraded to neutral, and between you and I got a lot of heat for it. But I think the reason that we downgraded is coming into fruition, because the reason that I think that the stock is acting this way is when you look out into next year, the growth has really been coming from a function of ad load growth, as well as engagement growth, and as well as user growth. Now, the users and the engagement are growing nicely, but the ad load will be stalling as we look into 2017 because of the fact that you just don't have another platform like an Instagram to open up. So the comps will get more difficult, and Messenger and Instagram, monetization, or Messenger and WhatsApp rather, will take a little bit more time, it seems, than I think some investors were hoping.
Instagram ad revenue growth, though, now faster than the actual website. It is what the CFO of Facebook told our Sarah Fryer.
Without giving us actual numbers, so we'll actually never really know.
We don't know a lot about the exact numbers behind Instagram's revenue growth. But in general, they're saying that the growth has been broad-based. How effective would you say Facebook at this point is with marketing?
One of the metrics I've always tracked with Facebook is the user value. And what you can see from a user, that is how much revenue they get for each user on the service. So yes, users use the service more and more. Nearly 2/3, just short of 2/3 of all users are on the service every single day. I think it's a very important metric. It's not just that they're Facebook members, they're Facebook users on a daily basis. It's part of their regular lives. But you can see the value of a user increasing dramatically. And really, 18 months ago, it was, I think, $4.25. The quarter they just reported is up to $6.08 for every single user on the site. That's an astounding number in one quarter, and to see that number also not, this service is not an immature business, and yet it has yet to show the true seasonality that an advertising-based business might show. That is to say, fourth quarter number is huge, third quarter numbers and second quarter numbers really slow in the summertime, like most ad-based companies are. It's still growing like a young company, even at this size.
At the same time, they are continuing to take a page from Snapchat. First, Instagram started doing Instagram stories. Now Facebook is saying that they're working on a camera-first sharing option on the main website. Take a listen to what Mark Zuckerberg just said on the call.
In most social apps today, a text box is still the default way we share. Soon, we believe a camera will be the main way that we share. We're already testing this in our main Facebook app with a version that has a camera directly just one swipe away from newsfeed with creative effects for your photos and videos. And in Messenger, we're testing new camera and video features. We'll be experimenting with even more visual messaging tools over the next few months as well.
James, sound like Snapchat much?
I mean, look, it sounds great, but it's not easy to change behavior. I mean, look at like digital payments. It's just not taking off. The Apple Watch, watches are, intuitive, but it's not taking off. So, video messaging versus, text-based communication it's a novel concept, but not easy. So I mean, the bottom line is this. I agree with Corey. Everything was fantastic across the board, but when you're looking at it from an investment standpoint, the street was looking for $37 billion in revenue in 2017. Now, the whisper expectations were more around $40 billion. And unless you get 10% upside revision to your 2017 numbers, the stock's not going to move favorably. So I think that's what you're seeing today. It's just a good performance, against a great performance expectation backdrop.
Over 1 billion daily active users now on mobile, Corey. There are 7 billion people in the world. The majority of them don't have the internet. At what point do we simply reach a ceiling?
Yeah, as you remember, when we looked at this as an IPO, we said that the two things they needed to do is they needed to get into China, or they needed to get into mobile, or the numbers weren't going to get a lot better. It was too expensive a stock, and it plummeted. It fell gently over its first couple months as a publicly traded stock for first couple quarters, and they figured out mobile. You've got 1.66 billion users on mobile. Mobile revenues of $5.7 billion, and it's dominating, as we mentioned, 84%. Now, to James' point, that flat 84% quarter-over-quarter growth, or I'm sorry, 84% in successive quarters, showed the lack of improvement in terms of mobile revenues. And so, while it's still a lot, 84% of all users, of all revenues coming from mobile, still maybe not more, and not more being not enough from a Wall Street perspective, from a business perspective. I think any of us would kill for these kinds of numbers. This
is a theme we've also talked about over the last several years, James, but with the rise of Snapchat, now we're seeing Facebook copy Snapchat, any number of ways. Does the coolness factor, come into play
James
at a certain
all about
point?
Coolness.
I know you're cool. That's why I'm asking you this question. And are you concerned that Facebook just isn't cool enough to sustain this growth over the next several years?
No, I don't think so. Look, they have Instagram. It's still incredibly popular. WhatsApp, Messenger, these are heavily used assets. And Facebook, and when it has all the scale. So, you go where the people are, and the people are on Facebook. So I'm not worried about the coolness factor. Now, one point on the engagement, I think, Corey, you were talking about, do you potentially hit a ceiling? If you look at the DAU over MAU, which is the daily, the engagement rate, that is the holding around 77% domestically, and it seems that we're not really creeping that much higher above that figure. So the question is, are you as saturated as you possibly can be, on the daily front in terms of users, and then extrapolate that across the international markets?
But given that number in the U.S., overall they had 66%. So that would give you, 1,000 basis points improvement potentially across the rest of the world, where the rest of the world gets more mature in it. It's also interesting to look at the desktop-only users down to 130 million. So increasingly, you've got people using Facebook on mobile. That's where it's happening. It's where it's happening every single day.
That was James Chalkmock of Monness, Crespi & Hart, as well as our Bloomberg TV editor-at-large, Corey Johnson. Still to come, what slowdown in the Chinese economy? Alibaba outperforms again with double-digit growth. How long will it last? Plus, we'll hear from a CEO betting that the Internet of Things will lead the way to a fourth IT revolution. This is Bloomberg. Mubadala Development has joined the list of investors looking to get a stake in SoftBank's multi-billion-dollar tech fund. This, according to people familiar with the matter, who say the Abu Dhabi investor is holding talks with the Japanese telecoms and internet giant and plans to incorporate money and sovereign investments into the potential $100 billion fund. SoftBank is also in talks with European and North American investors. If the $100 billion fundraising target is met, the fund becomes the biggest private equity fund in technology. China's largest e-commerce operator seems to be shrugging off concerns about a slowdown in the local economy. Alibaba posted second quarter earnings up 45% from a year ago, on revenue up 55%. The company is citing strength in cloud services, entertainment, and core e-commerce, still by far its largest business. We caught up with Bloomberg Tech Selena Wang and Kevin Carter, founder of EMQQ, an emerging markets ETF whose largest holding is Alibaba. Take a listen.
The emerging markets are just now getting the internet, and they're getting it on mobile devices. And the consumer in emerging markets is the real growth story. And just as the mobile and the internet has changed the way we consume, it's changing how emerging markets consume, China being the largest emerging market. And it's the reason you see such incredible growth. I mean, 55% top line growth for a company the size of Alibaba is quite extraordinary. I know just before this you were reviewing the Facebook results, and they also grew at 55%. There's not many companies of the size of those two in the history of the world, frankly, that can grow at faster than 50% on an annualized basis.
That said, there's been broader concern around growth in the Chinese economy overall slowing. I recently sat down with Mike Evans, president of Alibaba. Take a listen to what he had to say.
China's not in a bubble. The economy is slowing, but not slow. And the combination or the components of the economy are changing rapidly, from investment in old industrial and manufacturing to services and consumption.
As someone, Kevin, who focuses on emerging markets, do the GDP growth numbers in China concern you at all?
Well, they don't concern me. They're obviously slowing down. They've been slowing down for a decade, and they'll continue to slow down. This is sort of the law of large numbers. But I think that what was just said is absolutely right. I mean, yes, China's slowing. I don't think China is in a bubble. There might be pockets of overvaluation. There might be pockets of excess. But this is a secular story. This is the emerging market consumer. The Chinese consumer is a big deal. McKinsey calls it the biggest growth opportunity in the history of capitalism. And you're taking those consumers and you're now giving them the internet on a smartphone. And they're leapfrogging what we would think of as traditional consumption. They don't have the malls like we do. They don't have the strip malls. They don't have the SUVs to get to the strip malls. And so when you crash the emerging market consumer into low-cost smartphones, broadband internet access, and then local entrepreneurs, usually backed by U.S. venture capital investors, you get this incredible confluence of growth. And the whole emerging markets internet sector is growing at about 40%, the publicly traded companies of which there's 45.
So, Selena, break down the individual business units within Alibaba, from e-commerce to the cloud, and how each fared individually.
E-commerce still had some very impressive growth. As Kevin said, there was almost 50% in that core business. Cloud computing is something that all the investors have been watching very closely. It had triple-digit growth again, as did the new digital and media entertainment unit. Cloud computing still had some losses this quarter, but given the rate of growth, analysts are saying that it could become profitable in the coming quarters. So core business still strong, but you're seeing triple-digit growth in some of the other newer, faster-growing businesses.
At the same time, Selena, Alibaba is facing some questions around transparency. They've been, they say, making efforts to make the financials more transparent. At the same time, there's concern around Singles Day, which is coming up now in just a few days, and how they calculate revenue there. Tell us exactly what's going on with that.
So Joe Tsai did not give any more details this time. He just reiterated what he's been saying for the past few months, is that we're voluntarily cooperating with the SEC on the accounting practices. There was a recent New York Post article that said there's a whistleblower inside the company that's cooperating with Alibaba and giving them information. Joe Tsai came out and said, we think that's completely false. That's not real news. Will come out when there is real news. Still not a lot of details on what's going on right now. So basically, just to break it down a little bit, it was how they were accounting for their logistics business, Tainiao, and also how they were accounting for Singles Day.
Kevin, transparency issues around Chinese companies, especially Chinese conglomerates, not a new issue. But are these things that you think about?
Well, I certainly think about them. They're in the news. I'm not concerned about them much at all, to be frank with you. I think Alibaba is a very clean company. I think it's a well-managed company. And one of the things investors forget is that everything's relative. Investing in emerging markets is a risky proposition. And one of the biggest risks in emerging markets is corporate governance. You look at Petrobras. The giant Brazilian state-owned oil company. Those companies have serious governance problems. And it's not just Petrobras. All of the Chinese state-owned enterprises, which dominate the Chinese indexes and the emerging market indexes, about 30% of the big emerging market ETFs are in state-owned enterprises where corruption and fraud are rampant, frankly. And again, all you have to do is look at the headlines every day with Petrobras in Brazil, and you can see that there's a lot of risk and corporate governance risk that vis-a-vis the rest of emerging markets, I would say that Alibaba and the other emerging market internet companies that are backed by U.S. institutional investors have better corporate governance than you find on average.
Now, quickly, Selena, Singles Day, now just a few days away. Mike Evans told me that they're expecting more revenue than ever before. That is not a surprise. But talk to us about sort of broader expectations for this particular day and how they will be accounting for it given this additional scrutiny.
It's not clear how they're going to be accounting for this differently. I think we're going to be seeing that in the coming days and weeks. Mike Evans, in your interview, said that he expected the numbers to be even greater, and something that they're really emphasizing is all of the lead-up activities they're doing. They've already announced that Katy Perry is one of their global ambassadors. They have a slew of celebrities that are going to be on stage during Singles Day. They have this virtual reality shopping they're going to be testing out. They also have a fashion show where you can see what the models are wearing as they're walking down the catwalk, and you can buy those products ahead of time. So they've started to roll out so many more products and games and activities to kind of hook people into Singles Day well ahead of Singles Day, so that the minute the clock hits November 11th, we're going to see GMV numbers just skyrocket.
That was Bloomberg Tech's Selena Wang and Kevin Carter, founder of EMQQ. Coming up, Elon Musk unveils his latest project, and it is not a self-driving car or a rocket to Mars. We'll take a look into Tesla's first ever solar product next. Plus, there's never been a U.S. presidential election with as much big data analysis as we've seen this year. So what kind of impact is it having with just days to go before the U.S. election? We'll discuss later this hour. This is Bloomberg. Tesla's balance sheet may get a boost from SolarCity. The electric car maker is saying its pending acquisition of the solar panel provider could add $1 billion to its cash balance in 3 years. Tesla CEO Elon Musk, chairman of SolarCity, has been making the case for a tie-up since the deal was approved by SolarCity's board in August. The proposed deal has been criticized, with some critics calling the deal a poor use of Tesla's cash and a distraction from Tesla's car-making business. Meantime, Tesla is out with its first ever solar product, the so-called solar roof. Bloomberg's Tom Randall explains Musk's plan for a solar energy trifecta.
Take a look at the roofs of these 4 houses. Can you spot which one is covered in solar cells? That's a trick question, because they all are. Tesla just unveiled its first ever solar product, and it's stunning. It's not a solar panel. Instead, it's a range of 4 solar roofing materials that look virtually indistinguishable from high-end terracotta, slate, or slick modern asphalt shingles.
People really care about their homes. They love their homes, and they really want them to be better. And I think taking this approach, it can be.
Here's how it works. The top of the roof tile is made of textured glass. It looks like shingles from most angles, but it allows sunlight to pass through from above and into a standard solar cell with almost no loss in efficiency. Tesla says the glass is as tough as steel and can weather a lifetime of abuse from the elements. It can also be fitted with heating elements to melt off snow in colder climates.
You want to call your neighbors over and say, check out the sweet roof. It's like not a phrase that you hear often.
This represents the grand unification of Tesla's plans to become a sun-to-vehicle energy company. The idea is that you can run your home on solar power, store it in a slim battery that hangs on your wall, and then use that electricity to power your home and car. Tesla also doubled the capacity of that Powerwall battery, creating the world's cheapest lithium-ion storage to extend rooftop solar power into the night. This combination is perhaps the closest we've ever come to affordable off-grid electricity, though Musk was still a little fuzzy on the pricing details.
The goal is to make solar roofs that look better than a normal roof, generate electricity, last longer, have better insulation, and actually have an installed cost that is less than a normal roof plus the cost of electricity. So then why would you buy anything else?
The solar roof was Musk's closing argument to shareholders before their vote to approve Tesla's $2.2 billion bid to buy the biggest U.S. rooftop solar installer, SolarCity, to make it all possible. There are plenty of reasons to be skeptical, but if Musk can pull it off, this trifecta of Tesla products, the Solar Roof, the Powerwall 2, and the Model 3 electric car, will be available in Tesla stores across the U.S. by the end of 2017.
Competition to reign over the Internet of Things is heating up. One company looking to make its mark, C3 IoT, formerly C3 Energy, which recently closed a $70 million funding round led by TPG. Their aim to connect manufacturing equipment, medical devices, and all the other commercial equipment used by the world's largest companies. Funding for IoT companies peaked last year, hitting a whopping $3.2 billion, double what it was in 2012. But those numbers are expected to decrease to $3 billion this year, according to CB Insights. C3 IoT founder and CEO Tom Siebel worked at Oracle back in the day and joined us to discuss the current IoT landscape.
I've been in the information technology business now for 4 decades. So I've seen the transition from mainframe computing to mini computing to personal computing to internet computing to cloud computing, and each of these was an entire replacement market. It is clear, I think, that the next generation of computing is all about smart connected devices or the Internet of Things. And I think this is an entire replacement market for everything that's happening in enterprise software, just like all of the others prove to be replacement markets.
What are the limits of IoT? I mean, we hear everything, there'll be chips in our bodies, chips in our food, chips in our clothes. Where won't there be chips?
Well, I think all of that is correct. At the beginning of this century, there might have been 500,000 sensors out there. Today, there are 39 billion. In 5 years, there'll be 50 billion. In 10 years, each of us will have embedded in our bodies or be wearing perhaps 10 sensors. But all the value chains are being censored: healthcare, financial services, telecommunications, transportation, the energy industry, you name it.
You're taking on companies as big as GE, as well as a host of small startups, big companies like Microsoft backing, some of these upstarts. What do you have on them?
Well, when we started Oracle, we took on all the big software companies, and we did pretty well. When we built Siebel, we took on all the large software companies, Oracle, SAP, and IBM, and we did pretty well. And in each of those markets, we established and maintained a market leadership position globally. We have about 100 million sensors under management today, which is 100 million more than anybody else in the market. So far, we're doing pretty well. What about
the security issues, the cyber attack issues, and the fact that, for every chip means another potential vulnerability?
Well, I think, first of all, this is a critically important issue to which we do not pay enough attention. Okay, and you look at the threat that critical infrastructure is under. Now, there is a myth, however, that somehow data are more secure behind our own firewall than they are in cyberspace. And I would argue that the opposite is true. See, NSA for details. See Department of State for details.
What do you mean by that?
Well, the data used to be secure in our own data rooms when it took, a forklift to move a storage device. It no longer takes a forklift. But I would suggest the only opportunity where we can really secure data, using encryption and avoiding penetration, is in cyberspace. I think this is the place where we can secure it.
That was C3 IoT founder and CEO Tom Siebel. Coming up, we'll hear from former Microsoft chief turned LA Clippers owner Steve Ballmer. His take on the U.S. election, Trump versus Clinton. Plus, Silicon Valley's most divisive voice stands his ground. Peter Thiel defends his support of Donald Trump and says he's not the only one. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Emily Chang. With the U.S. presidential election just days away now, we've been covering how the results could impact business getting done in Silicon Valley and the repercussions for tech globally. I sat down with former Microsoft CEO Steve Ballmer and got his take on the pending election and what businesses stand to gain or lose. Take a listen. I know you typically vote Republican. What is your thought on this?
I've never said that, and that I am a definite independent. I'm not registered with either party. I am an independent. I care about issues deeply, and I'm willing to vote for anybody who shares my interests.
What do you think a Hillary Clinton presidency would mean for innovation, jobs, the economy? What would a Donald Trump presidency mean for those same things?
I've read their tax plans. I think that at the end of the day, neither one of the plans have much to do with job creation, frankly. I actually probably am a little less convinced that federal government action or local government action has anything to do with job creation. I think job creation comes out of productivity gains, which comes out of innovation.
Do you think that this election has become too much about not the issues and not enough about what's important?
Number one, I think this election's become a lot about personality. And I'm sure that should always be a little part of things, but I think on both sides, that's really been blown up.
We've seen so many people in Silicon Valley and the tech industry come out saying that they are against Donald Trump. They are voting for Hillary Clinton. Why not be more public about it?
I would advise most CEOs to keep their political opinions to themselves.
Why?
They're going to be running their businesses under either administration. Their shareholders may not agree with their views. Companies should represent the views of their shareholders, and whatever happens, probably at least 40% of people will vote for either of the two candidates. So I don't really think that that's a good thing to do. Companies should stand up for their issues, but I don't think they should pick candidates, or at least I wouldn't want a company in which I am an investor to do so. As a private citizen, I'll vote my mind, but the thing I'm going to emphasize is the issues I care about and the facts.
My conversation there with Steve Ballmer. Be sure to catch my full interview with Ballmer on Bloomberg Studio 1.0 this weekend on Bloomberg Television and Bloomberg.com. Meantime, Silicon Valley investor and entrepreneur Peter Thiel has opened up about his support of Donald Trump this week. At a National Press Club event in Washington, the billionaire businessman said the presidential nominee represents a new Republican Party.
No matter what happens in this election, what Trump represents isn't crazy and it's not going away. He points toward a new Republican Party beyond the dogmas of Reaganism. He points even beyond the remaking of one party to a new American politics that overcomes denial, rejects bubble thinking, and reckons with reality.
Thiel has been a political lightning rod this election season, attracting scorn from Silicon Valley leaders who almost uniformly oppose the Republican presidential nominee. Despite this criticism, Thiel recently increased his support by donating $1.25 million to Trump's campaign. Now, let's turn to big data and what it can tell us about voter sentiment at this moment. CrowdPack is an independent, nonpartisan political data startup whose mission is to make it easier for voters to learn about who's running for office. You can log on, take a quiz, get information about which candidates share your views. All of its data is based on public information, from fundraising disclosures to voting records. Take a listen to our interview with CrowdPack CEO Steve Hilton.
There's a really interesting thing that's happened in relation to the people who used to support, on the Republican side, those really aggressive challengers to establishment, Republicans like Paul Ryan and so on. They seem to have been flocked to Trump. So there's a way of describing it which says that the Tea Party has become the Trump Party. The other thing that's happened on the other side is that you've seen a lot of consolidation behind Hillary Clinton, where a lot of the holdouts, if you like, the Bernie Sanders supporters who really couldn't bring themselves to get behind her, they finally do seem to be coming her way in terms of at least their donations, if not necessarily in all their opinions about what she might do as president. So there are some interesting changes, but I think actually the kind of data that we're providing now for our users, where it's going to be most useful is probably not at the presidential level, but lower down the ballot, where people really haven't got any idea about who the candidates are for state legislature and so on. Those really important positions that affect education and healthcare and transportation and really big parts of people's lives. And yet candidates often get on the ballot without anyone really understanding where they're coming from. And we think that our data, which looks at who's giving them money, gives our users a really good guide as to where the candidates stand and who might be closest to their view.
You found, as you mentioned, that Clinton has finally consolidated convicted Democrats, but it's really happened, in the last few weeks. You also found that she's vastly outraised Trump in every industry except for agriculture. Tell us about the trends you saw.
Well, it's just that, to be honest, he hasn't put that much effort into fundraising. He's, if you like, pioneering a new approach to election campaigns, which is you don't go out there and try and raise as much money as possible. And it's interesting that the Republican candidate is just not getting the support of business right across the board, apart from that one sector, as you described. And I think of particular interest to our audience, the tech sector is almost completely united behind Clinton. Obviously, Peter Thiel has been a high-profile exception to that. But generally speaking, technology, like other industries, getting behind Clinton.
And what about smaller donors in general? How have both of the candidates handled them?
Well, Trump's actually done more recently. He's actually done really well with small donors. He's actually made a bit more of an effort. That seems to have happened over the summer. Clinton has certainly diversified her base somewhat, but she's still very reliant on some of those big donors, and actually Trump is the one that seems to, in the more recent period, to have done better at mobilizing small donors. So I still think that, frankly, at the presidential level, there is still far too much influence of the big check writers, the big donors, and we've got a long way to go, I think, before we get that true democratization of political fundraising, which is one of the reasons we started CrowdPack.
In the last week before an election, what benefit can fundraising have? I know there's last-minute fundraising going on. What impact does it really have?
Well, I think that there's two really important things to bear in mind. First of all, at this late stage, one of the most familiar things that campaigns do, which is spend money on ads that people in certain parts of the country get absolutely sick of because they can barely turn on the TV without seeing a political ad. That doesn't really deliver you much benefit at this late stage because you can barely even buy the inventory to have an impact. But the really crucial point is actually the way the political system works. Because of the Electoral College, the fact that the election is decided state by state, the fact is that if you live in one of the many states in America which are basically solidly Democratic or solidly Republican, your vote is really unlikely to shape the outcome of the election. That's why we hear so much about all the battleground states. Now, one thing that's really interesting that's happened just recently, in the last few days actually, is someone's created a crowdfunding campaign on CrowdPack to raise money to give people rides to the polls in those battleground states. So they're teaming up with Lyft so that if you donate money on crowdpack.com to this particular crowdfunding campaign, which is right on our homepage right now, then even if you live somewhere like California, if you're watching this in California or New York, one of those solid Democratic states, frankly, looking for something to do to try and support Hillary Clinton, this is one of the most useful, practical things you can do to actually give money so that people who live in the battleground states where the election is going to be decided can be helped to actually get that very practical help to get to the polls and vote on election day.
Good to hear that you guys are doing that. Now, sites like CrowdPack didn't really exist in the last election. I mean, your goal is to educate voters and make sure they have more information than ever before. Do you see evidence that it's working, that voters are more educated than they were 4 years ago?
I don't know. I think that's definitely a really big part of our mission. We want people to participate in politics at every level. We're trying to build tools that help them to run for office, especially at the local level where we want people to engage and also to be better informed when it comes to vote. And as we've just discussed, to raise money so we don't have a political system that's so dependent on big donors. I think there still is a real problem, though, with the fact that so many people are just not interested and really turned off, especially in this election season, where the candidates at the top of the ticket, both of them in their different ways, have proved so unattractive. I still think we've got a long way to go. And then for us at CrowdPack, actually, we think that focusing on the local aspect of politics is probably the best place to start, because there people can feel if they run for office in their local community, they really can make a difference. And you can see the difference you make if you run for school board or your local council. And there's less cynicism, less partisan bickering. We think that local politics may be the best place to get people engaged.
Last quick question, Steve, on the presidential election. You know, there are concerns that polling might not necessarily be representative of the actual results. We saw this, of course, with Brexit, you know, which I know you're very familiar with. What are the chances that, and Hillary's leading in the polls, yet the polls are tightening. What are the chances that that this election turns out, that the results turn out to be different from what we believe them to be?
Honestly, I think there's a really high chance of that. And I think it speaks to one of the big similarities between what's going on in this election and with Brexit, which is that you've got a huge group of people here in America, as you had in the UK, who for many years have felt that no one's really listening to them. Their incomes have fallen, they're losing their jobs, they feel really let down by whoever's been in power, whether that's Labour or Conservative in the UK or Republicans or Democrats here. And so their attitude is, look, what difference does it make? We've given up on politics. They haven't voted for many years. Now, those are the people that actually with Brexit thought, you know what, here's a one-off chance to really make a statement and get a big change. And they're seeing the same sort of thing with Trump. So I wouldn't be surprised if there's a lot of people out there who are secret Trump supporters who've given up on politics, think he might be the kind of disruptive shake-up that the system needs, but are afraid to say so because of all the attacks on Trump that they see all over the place, particularly in the media.
That was CrowdPack CEO Steve Hilton. Coming up, Toyota is heading down the ride-sharing road. We will break down the automaker's new deal with the startup GetAround next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. This week's Tech Funding Board. India's largest ride-hailing startup, Ola, is in talks to raise about $600 million. This according to a person familiar with the matter who says that would give the company enough capital for at least 18 months. Current Ola investor SoftBank is said to be planning to participate in the round. And staying with ride-sharing, Toyota is the latest automaker hopping in. The Japanese car maker announcing a partnership with GetAround, a San Francisco-based startup that allows car owners to rent out their vehicles when they're not in use. The test program will start here in San Francisco, January 2017. We caught up with GetAround CEO Sam Zaid. Take a listen.
We're partnering with Toyota in two ways. So one is on the technology side, the other is really on the finance side. And so the simple way you can think of it is you can walk into a Toyota dealership, essentially buy a car, finance or lease a car that you then will share on GetAround and pay for the car out of your earnings through the GetAround sharing platform.
So it's so, I mean, I've talked to you a couple of times over the years, and you saw your first sort of burst of publicity before Uber and Lyft were anything. And I'm so curious how the business and your philosophy has evolved as ride sharing has taken off.
So actually we see them as very complementary. So I think the shift you're seeing amongst consumers and companies like Toyota are seeing is this move towards accessing transportation through like a smartphone on demand. And so more and more people are moving to a world where they are living car free and they need access to mobility services. And so you can use something like Uber or Lyft and GetAround in a very, very complementary way. And so that's actually great for us because, as these companies like Uber and Lyft are, changing how consumers use and consume transportation, that's actually creating a whole new market for GetAround.
In a future of self-driving cars and, as many Ubers or Lyfts on the road as I could possibly want, why would I actually want to own a car at all?
Yeah, so you have a choice. I mean, what's happening now is we're making it really easy to own a car for free. Integrating our technology with that of Toyota's to make it, come that way right out of the factory. So you could choose to own because you want a particular car or because sometimes you might need a car every day of the week. But you could also choose to live entirely car-free and then just rent cars on GetAround. So it's really giving more power to the consumer and allowing them to make that choice and making things just that much more fluid.
Elon Musk says he's also trying to do something similar to what you guys do. What do you make of the Musk plan?
Yeah, I think we love it. I mean, it's great. It's great to see Elon embracing car sharing that way. We've had Tesla shared on GetAround for over 4 years at this point, from Roadsters to Model S's to Model X's. So, for us, it's really just validation that this is happening. It's just going to happen faster and faster.
So do you see, paint the picture for me in, let's say, 5 or 10 years. Do you see that a certain number of people just won't want to have a car? Some will still want to have a car. Some will still want to have a car and use it only themselves. Like what sort of percentage do you see doing each thing?
Yeah, so what we believe is, sometime 5 to 10 years from now, sharing cars will be the predominant way people use a vehicle. The concept we have today of everyone buying a car and sort of using it themselves, that's with technology advancements, that's just going to go away. And fundamentally, it doesn't make sense. It's not sustainable. We have 250 million cars in the U.S. We use them 5% of the time. That's just a waste of like a massive amount of resources. And I think what you're seeing now is technology is enabling consumers to be much more efficient, and that trend's only going to accelerate.
So how big a market do you think this will be for Get Around?
I mean, this is the car market. This is the same as the ownership market. I think what you're really seeing is just a adjustment, a refragmentation, a change out in the value chain of how you own and operate vehicles as an individual consumer.
All right, Sam, hang on a second. I want to turn to the larger industry now. Uber just announcing a partnership with GM's Maven. And remember, GM is also a major backer of Uber rival Lyft. I want to bring in Eric Newcomer for more. Eric, what more can you tell us about this?
Yeah, it's a pilot program right now between Uber and GM. It's 90 days in San Francisco, but there's clearly interest for the two companies to work together more. General Motors has been building out its own car sharing business called Maven, and so it wants to find ways to get those cars out to consumers and then also to businesses like Lyft and Uber.
So look, Sam, you're not just competing with Uber and Lyft and Tesla, but also GM. What do you think will truly differentiate Get Around from all of these different options?
Yeah, so I think our model is fundamentally different, right? These are people's cars that they're sharing with other people. So we don't own the cars like GM Maven. That's fundamentally a very big difference against a lot of the OEMs. And we've been doing this for a number of years, so we have developed quite a lot of unique technology and intellectual property in this space, and we feel that that's one of the reasons why Toyota chose to work with Get Around. Is they looked at all the partners globally and ultimately decided that what we've developed and how we see the future of the world, those two things were very aligned, and so we feel that that puts us in a very unique position, and we intend to just continue innovating like we have for the past few years.
Eric, look, there are a ton of different automakers. There are a ton of different ride-sharing services. As of now, there are different permutations of how they serve customers. Is there room for everyone, or will there be some sort of consolidation?
I think there'll probably be some consolidation, but at the same time, I think all these companies see the same trends that show what they're growing toward. A move to the city, a move away from maybe car ownership. So if those things happen, if more people are living in cities and those cities are crowded, they don't want to deal with managing their own cars, then you could see a number of successful players and a number of successful models. You take an Uber around the city, but then you want to go out for a hike or something, you use a car share. So I think there's room for multiple sort of types of companies and players within those spaces, especially if there's a movement sort of culturally.
How do self-driving cars, Sam, fit into your vision for the future?
We really welcome self-driving technology, and even when we started Get Around, we anticipated this would happen eventually. Maybe first starting with the connected car, moving to the autonomous car. But that just makes our model that much more fluid. It means you can share your car with more people in more parts of the city.
And do you see people wanting to own a self-driving car just like they own a non-self-driving car today? Or is the model for self-driving car ownership different than car ownership as we've known it?
Yeah, I think car ownership will change, but I think you will still see individuals owning cars. You might see micro entrepreneurs owning small fleets of cars, and then you very well may see large fleets of, large corporates owning large fleets of autonomous cars or self-driving cars. I think what you're going to find is that the idea of just everyone owning a car will change, but I don't think it's going to just, the pendulum will swing entirely to just having a couple of companies owning all the cars in the world.
That was Get Around CEO Sam Zaid and Bloomberg's Eric Newcomer. Still ahead, Electronic Arts is boosting its outlook for the ever-important holiday quarter. We'll break down the latest in gaming next. And remember that all episodes of Bloomberg Tech are now live streaming on Twitter. Check us out at Bloomberg Tech TV, weekdays 6 p.m. in New York, 3 p.m. in San Francisco. This is Bloomberg. The two biggest daily fantasy sports sites are close to joining forces under the leadership of DraftKings co-founder Jason Robins. This according to people familiar with the merger talks. Robins is expected to serve as the CEO of the combined company, still unnamed. Investors have been encouraging a tie-up for months as the two companies have spent millions competing against one another and fighting legal battles. Well, Electronic Arts beat estimates for the second quarter, adjusted earnings falling 18% to 53 cents a share on revenue that also fell 4% to $1.1 billion. Investors closely watching guidance for the holiday quarter. EA raised its forecast, but still lower than some analysts had estimated. Wedbush analyst Michael Pachter and Bloomberg Intelligence analyst Matt Canterman joined me to discuss.
EA continues to deliver on very strong results. The core franchise, the FIFA business, the Madden business, and the other sports games are performing very well, with FIFA engagement up significantly year on year versus the prior year launch. They have some new games coming out the holiday quarter, Battlefield 1 and Titanfall 2, which appear to be off to a good start. All in all, you know, the new games here are doing very well in the early stages, and it looks like this company is executing on its strategy well.
Now, you mentioned the new shooter games. EA is mostly, though, known for its sports titles. Michael, how do you expect the categories to stack up?
Sports is pretty stable. I mean, FIFA's been growing, Madden hasn't. Basketball has kind of faded into obscurity, and they're kind of every other year with golf. So, you know, overall, you're talking about really modest growth. But in the shooter category, as Matt said, they have two big games this quarter. They only had one last year, the Star Wars Battlefront game. So they should be up hundreds of millions of dollars year over year in that category. So it's a much bigger growth vehicle for them.
Now, Matt, last year at this time, we were focused on the Star Wars Battlefield game. What's the big focus this year?
The big focus is definitely those new shooters and also their expansion into new platforms. Mobile gaming growth is a big opportunity for them. And you mentioned Star Wars Galaxy of Heroes. It launched almost a year ago now, continues to be the driver of mobile growth. They launched a new FIFA mobile game. They have some new games coming in that area. And they've also done some new things with new platforms, new technologies such as virtual reality that are coming online this quarter.
Michael, you know, we talk a lot about the transformation of these companies in a digital world. Online purchases now making up 63% of the quarter. How well has EA really managed the transition, you know, to a digital world?
I think they're probably a bit better than anybody. I mean, the only company that compares to them in the West is Activision. And Activision, you know, purchased King, so that's about a third of their revenue. EA has been doing this mobile for 15 years. They're not particularly good at it, but they're positioned finally to thrive. They're as good as anybody in downloadable content, in in-game transactions, in full game digital downloads. So they've actually been pretty good in anticipating this shift, and they were ahead of the curve. It hurt them, you know, 5 years ago. The stock couldn't get out of its own way, but they just started to execute in the last 3 years, and the stock's been on fire.
And that does it for this edition of the Best of Bloomberg Tech. We will bring you all the latest in tech throughout the week. And remember, tune in for our latest episode of Bloomberg Studio 1.0, my full interview with Steve Ballmer, former CEO of Microsoft and owner of the LA Clippers. This is Bloomberg.